Gold just touched $5,228 per ounce, a 3-week high, and within hours it fell back. Most people are calling it profit booking, but there is a number buried inside this pullback that nobody is talking about. And if you understand what that number means, you will see exactly what is coming next for gold. Welcome to the Capital Anchor. I am here to cut through the noise and show you what is actually happening in markets while everyone else is distracted. If you are new here, I break down what Wall Street does not want retail investors to understand. Subscribe right now because what I am about to show you changes everything about how you read gold's next move. Let's start with exactly what happened today, February 24, 2026. Spot gold fell 0.8% to $5,189.99 per ounce in Asian trading hours. It had just hit a 3-week high. The rally that built for 4 consecutive sessions wiped in hours. U.S. gold futures for April delivery dropped 0.3%, settling around $5,210.4. Silver also fell, sliding 1% to $87.38 per ounce after touching a 2-week high just one session earlier. The mainstream explanation: profit booking and a firmer dollar. Simple, clean, and completely incomplete. Because here is what they are not telling you. Gold gained 2.5% in a single session on February 23rd. That is not a normal day, that is panic buying. That is institutional money moving fast, and when money moves that fast, the pullback is not weakness, it is controlled digestion. Ilya Spivak, head of global macro at Tasteliv, said it clearly on February 24th. He noted that it is noteworthy that the panic seen on Wall Street did not extend into Asian markets. That sentence is doing a lot of heavy lifting. What he is really saying is, gold held its structure even after a massive one-day surge. Now let's talk about the dollar. The dollar index, the DXY, edged higher on February 24th. It was sitting around the 97.7 level. And because gold is priced in dollars, when the dollar strengthens, gold becomes more expensive for buyers outside the US. That reduces demand from overseas. That puts downward pressure on the price. This is the standard explanation. But here is what most people miss entirely. Think of the dollar and gold like two ends of a seesaw. When one goes up, the other tends to go down. Right now, that seesaw is tilted toward the dollar. The DXY edged higher. Gold pulled back. That is the mechanism. That is the physics of this market. But here is the part nobody is showing you. The seesaw is sitting on a broken foundation. Reason number 1: the dollar firm today is geopolitical uncertainty around tariffs. President Donald Trump warned on February 24th that any country backing away from recent U.S. trade deals would face significantly higher duties under different trade laws. The Supreme Court had already struck down his emergency tariffs, so now Trump is threatening alternative legal pathways to impose even harsher penalties. That threat created a short-term flight into dollar-denominated assets. It made the DXY tick up, and it put pressure on gold momentarily. But here is the contradiction. Tariff threats are exactly what drove gold up to 0.5% the day before. The same force that pushed gold to a 3-week high is the same force that briefly strengthened the dollar and caused gold to pull back. It is the same news cycle, creating two opposite price reactions in less than 24 hours. That is not a market behaving rationally. That is a market searching for direction. Reason number 2 is the Federal Reserve positioning. Fed Governor Christopher Waller said on February 24th that he is open to holding interest rates at the March meeting if upcoming February jobs data shows the labor market has stabilized. The Fed currently sits at a rate range of 3.5 to 3.75%. Markets are pricing in 325 basis point cuts this year, according to CME's FedWatch tool. But the probability of a March cut? Just 7.9%. That means 92.1% of market participants expect no cut in March. When rate cuts look less likely in the near term, the dollar strengthens. A stronger dollar pressures gold, and retail investors see gold fall and assume the bull market is cooling. That is exactly what the institutions want them to think. Reason number 3 is the technical reality of overbought conditions. Gold had been rising for 4 straight sessions before today. The RSI, the Relative Strength Index, had pushed into territory that professional traders use as a trigger to book profits. When gold approached the $5,228 level earlier today, traders who bought lower in the week saw a clean exit point. They took it. That is, Not panic selling, that is professional execution. Retail investors watching the red candle on the chart feel fear. Institutions watching the same candle feel satisfaction because they just locked in gains before the next leg. Here is the real disconnect that should make you stop and think. While retail investors are reading headlines about gold falling from a 3-week high and interpreting this as a sign of weakness, central banks around the world purchased 863 tons of gold in 2025. Not dollars, not bonds, gold. And in 2026, central bank purchases are projected to remain at 850 tons, that is still nearly double the pre-2022 average of 400 to 500 tons per year. While you were watching gold pull back 0.8% today, they were sitting on hundreds of tons they accumulated at far lower prices. J.P. Morgan Global Research projects average quarterly demand from institutions and central banks at 585 tons in 2026. That is not a number that suggests a structural retreat from gold. That is a number that suggests the floor has been permanently raised. Goldman Sachs raised its December 2026 gold price target to $5,400 per ounce. Bank of America views the current consolidation as a pause, not a peak. The World Gold Council says gold could rise 15 to 30% in 2026 after gaining roughly 65% in 2025. Every single major institution is leaning the same direction, but the mainstream media is covering a 0.8% daily pullback as if it changes the thesis. But here is where it gets truly interesting, because the next 72 hours will either confirm a continuation of gold's bull run or reveal something much more important hiding beneath the surface of this pullback. Gold was trading around $2,600 per ounce. It had just hit a then record high. Profit booking hit hard. The dollar firmed. Headlines said the rally was exhausted. Retail investors who panicked and sold at that point missed a 100% move higher over the following 14 months. Gold went from $2,600 to over $5,200. That pattern is not random. It repeats every major leg in gold's bull market since 2022. Has been followed by a sharp short-term pullback. A round of gold is done headlines, and then a continuation to higher levels. February 24, 2026 looks identical to those prior inflection points. Same structure, same narrative, same reaction from retail. The question is not whether gold pulled back today. It did. The question is whether the conditions that created this bull market have changed, and they have not. Here is what has not changed. The 4 structural pillars still standing. First, central bank buying remains historically elevated. In 2025, central banks globally bought 863 tons of gold. The pre-2022 average was 400 to 500 tons per year. That demand floor has been permanently reset. No profit booking event changes that. No single DXY tick higher reverses that trend. Second, de-dollarization is accelerating. Russia, China, India, and over 40 emerging market nations are actively reducing their U.S. Treasury holdings and increasing gold reserves. China's People's Bank of Gold resumed publicly disclosed gold purchases in November 2024 and has not slowed since. They are not buying gold because of tariff noise. They are buying gold because they are rebuilding their monetary reserves outside the dollar system. Third, the Fed rate cut cycle is still intact. The market is pricing 325 basis point cuts in 2026 via CME's FedWatch tool. Every rate cut reduces the opportunity cost of holding gold. Every cut weakens the dollar's yield advantage. The direction of travel is clear. The timing is debated, but the destination is not. Fourth, supply constraints are tightening. Global gold mine production has been essentially flat since 2018. New major discoveries are rare. It takes 10 to 20 years to bring a new mine into production. The supply side cannot respond quickly to demand surges. That structural deficit does not disappear during a one-day pullback. Now, on the record screenshot this. Gold will trade above $5,500 per ounce by June 30, 2026. That is my prediction on the record today, February 24, 2026. The reasons are clear. Fed rate cuts arriving in Q2, continued central bank accumulation, dollar structural weakness driven by U.S. fiscal deficits now exceeding $2 trillion annually, and tariff uncertainty that historically drives safe haven flows. The current pullback to $5,189 is a gift, not a warning. Now let's talk about the three scenarios. Scenario 1. Gold resumes its uptrend and breaks $5,400 by April 2026. This happens if February jobs data comes in weak, the Fed signals a May or June rate cut, and tariff tensions remain elevated. Probability 60%. Scenario 2. Gold consolidates between $105,350 for the next 6 to 8 weeks before breaking higher in Q2 2026. This happens if the Fed remains cautious, the DXY holds above 97, and no major macro shock occurs. Probability 30%. Scenario 3. Gold pulls back sharply to the $4,800 to $4,900 range if a surprise Fed rate hike or major dollar surge occurs. This is the tail risk scenario. It is possible, but not the base case. Probability 10%. Now let's talk about you specifically, because where you sit today determines what you should do next. If you are holding physical gold, do nothing. The thesis has not changed. A 0.8% daily drop in spot price does not affect the ounce sitting in your safe. Continue holding. The institutions are holding. Central banks are holding. You should be holding. If you are trading gold with leverage, today is a day for discipline, not action. The short-term volatility is real. Leveraged positions in a consolidating market can get stopped out before the move you predicted even begins. Reduce exposure. Wait for the $5,100 to $5,150 support zone to confirm before re-entering. If you are sitting on cash and watching from the sidelines, understand what you are actually doing. You are waiting for certainty in a market that never gives you certainty. The data is already telling you the direction. Every week you wait above $5,000 is a week the next leg is getting closer without you. If you bought gold at or near the top around $5,200 to $5,228 and you are now slightly underwater, do not panic. You bought a 3-week high. That is not ideal timing. But you bought in the middle of a structural bull market with central banks buying 863 tons per year. Hold the position. The thesis will bail out the timing. Here is what to watch going forward. These are your 4 indicators. Watch the DXY. If the dollar index breaks below 97, gold will likely surge. If it holds above 98.5, expect continued short-term pressure on gold prices. Watch COMEX gold inventory levels. If registered gold stocks at COMEX continue declining, they have been under pressure throughout early 2026. That signals physical demand is outpacing paper supply. That is a bullish structural signal. Watch the February U.S. jobs report. This drops in early March 2026. If the number comes in below 150,000 jobs added, the Fed's case for holding rates weakens dramatically. That would likely trigger a gold surge. Watch central bank purchase disclosures. The World Gold Council releases monthly data. If February 2026 numbers show purchases above 70 tons, the structural demand case gets even stronger. Now, 3 types of people are watching this video right now. The first type is panicking. They saw gold fall 0.8% today and they are calculating losses. They are about to make an emotional decision with money that deserves a rational strategy. The second type is frozen. They have been watching gold rise for 14 months. They want in. But every time they are about to act, a headline like today's stops them. They will keep waiting until gold is at $6,000 and then finally buy in fear of missing more. The third type is learning. They watch today's pullback and ask the right question. Why did this happen, and does it change the thesis? They know the answer now. They are preparing calmly while others react emotionally. Markets are nothing but wealth transfer machines. They move money from the impatient to the patient, from the uninformed to the prepared, from the person who sells at $5,189 because of a daily red candle to the institution that accumulates every dip because they understand the decade-long forces driving this market. Gold fell from a 3-week high today. That is the headline. But the actual story is that every major structural driver, central bank demand, de-dollarization, Fed rate cuts, supply constraints, remains completely intact. The noise is loud, the signal is clear. If this video gave you clarity, give it a like right now and subscribe to Capital Anchor, because I am here every week showing you what is actually happening while the mainstream media keeps you distracted. Share this with one person who is confused about what to do with gold right now. They need to see this. And drop one word in the comments. Type holding if you are staying the course, or type watching if you are still on the sidelines. I read every single one. This is not financial advice. Do your own research and consult a qualified financial professional before making any investment decisions.